If you were to enter a short perpetual trade now, what would be your stop loss level? So this is actually a quite interesting question. Where do I set my stop loss levels whenever setting relative valuation trades? For the long side, so let's say I go long Bitcoin, I don't have any stop loss, right? Because this is simply just my hedge. For the short side, I tend to set the stop loss depending on where currently the trend channel is. So I look at the relative valuation chart, and then I just draw trend lines and I check how much can we potentially wick out of those trend lines and take a bit of extra buffer. And usually I don't want to set my stop loss beyond, say, 15, maximum 20% from the current price level. If you have to set a stop loss that's even further away than that, that's a problem, right? Because then we don't find a proper entry. Let me show you what I mean. So let's have a look at a chart. Let's take a random altcoin that tends to underperform very long term. So let's take a balancer, and I don't take the balancer price itself. I enter /others. So that's the others market cap. And then because TradingView has a few problems plotting very small amounts, I add a few ones plus zeros behind this so that the logarithmic chart doesn't have a problem. So this is then the chart that we get, balancer relative to the others market cap. Maybe we even find a balancer chart that's a bit more long term if we don't calculate this in Tether, but in regular USD. No, it's the same chart. But yeah, so here we can see a quite nice chart that makes sense to short, right? We want to bet on falling prices of balancer because it tends to underperform. And recently with the crypto crash, it went down even further. Now, I haven't looked at this chart for a while. I'm currently not shorting balancer. It's not available on perpetual futures. You can, I believe, still borrow it on the Aave protocol. So if you want to borrow balancer and then swap that balancer versus Bitcoin and enter this short, you can definitely do so. But what you want to do is you want to draw charts like this. You then want to have a parallel line for the tops, right? You first look at where do you have most price points touching a potential trend. So you go from the line, it might be the bottom or the top, where you see a lot of price touches. Once you've got that line, you copy paste that line so you've got something parallel, and then you try to find the parallel line at the bottom. So this could be over here, right? Because we've got a turnaround point here. We can also look for secondary tops where you maybe have seen turnarounds before. So we've seen one here, and so this would be my potential profit taking, short-term profit taking if we hit bottoms around here, and my stop loss when entering a short would be around here. Now this is not a great entry opportunity for a short because very likely when we now measure this from the top, this is more than just 10-20%, right? So we can't set a stop loss at 200% above the current price level. But in theory, right, if we were much higher on this chart, if we were before this recent crash at this level here, and we check how much could we go up, this here is 25%, that's already a bit too much. This here is a bit closer, this is around 8% or so, this makes more sense. We can then also have a look at the potential wicks. So balancer does get sometimes short squeezed, it does get its wicks. So it did wick up 40% above. And so that's always a problem, right? So we can't really necessarily set a stop loss not to get wicked out at 40%. What we can do, if we want to get a bit fancy, is we can set our stop loss at the regular trend line, right? So let's say we are somewhere around here. We have a stop loss at around 10-15%. But then just as a potential entry, right, in case we do see another scam wick like this, in case we do see another short squeeze, we could also, besides just entering the stop loss here, we could add a limit order to enter a short at price levels at around here. Okay, so maybe 30-40% above the current price level. So we would not expect to enter that short outside of a short squeeze, but if we do get short squeezed, right? So let's say we do hit our resistance level and it goes higher and higher and higher, then we would automatically enter another short at a higher price level because we've already got this in our order books. I personally don't do that often because it's quite a lot of management, because as the price moves, we also then have to adjust this short squeeze protection level. It is a bit cumbersome, but for assets that do get short squeezed every now and then, and Balancer at least used to be one of those assets, in that case, you do want to also have a short order laying around that's much higher above the current price level that then automatically enters. But yeah, very good question. I think this is important. Risk management is one of the most important things when betting on relative valuations, because if you do not manage your risk properly and you get squeezed out, right, when the price suddenly rallies by 100, 200%, and you've got, say, 20, 30% of your portfolio in a single short position, then you might suddenly lose half of your portfolio. So you want to be wise in terms of how much you bet per relative valuation short, right? You don't want to bet more than, say, maximum 20% of your capital. Ideally, rather, say, 10% of your capital. That's one point. The second point is, of course, you want to have proper stop losses in place. And I do this for the short position. For the long position, I normally don't do this because the long tends to be Bitcoin, Ethereum, and Solana. And yeah, those tend to not crash that quickly. And if they do crash very quickly, then most of the times the altcoins will crash even further, and then we are still in profit anyways. If you are a newbie investor and have 50K and looking for at least 5% return a month, where would you invest? Please explain like I'm a 5-year-old. Okay, so you might have already noticed by my intonation of the question that 5% return per month is a very high ask. Most people achieve this in a year. Even Warren Buffett in his golden time did not beat the S&P 500 by that much. His annual alpha in the early years, up until the 1980s roughly, was between 20 and 30% outperformance versus the S&P 500. Now, if we are in a market that's less efficient than the stock market, that's smaller, like the crypto market, and we are good, we can generate more alpha. But if we don't want to risk all of that capital, so it also depends a bit on how much the 50K mean to you. Let's say you've got an annual income of 200K and the 50K is just a few months of savings, then you can go quite risk on, and even if you lose it all, it's fine. You just wait a bit longer, you just save a bit longer and you're back. If your annual income is 25K and this is several years of saving, then the 50K mean much more to you, and then you should already diversify this relatively well. I personally, in the crypto market over the last 5 years, made a monthly alpha over buying and holding Bitcoin of 2.1%. So that's my return, and that's relatively risk off, I'd say. So I try to be within the crypto portfolio, try to be quite diversified, try to not take too much risk, but I'm also doing this full time. And for my entire net worth, of course, it also depends on what you measure this against, right? Because it's an asset class mix. In US dollars, of course, I make more than 2% per month, but the Nasdaq also appreciated quite a bit in the last years, and property also appreciated quite a bit in the last years, and then we've got leverage in property through mortgages. So yeah, it's always the question, what's your benchmark? If you just look at crypto and crypto is your investment, try not to have your expectations too high. Try to start with relative valuation trades if you want to. If you've got a longer time horizon, you can also try to time the market using the moving averages, like the 125 day or for spot trading, or if you do some leverage, the 44 day, and just do that and then continue learning, right? Continue learn as much as possible, not just this channel. Try to find channels that you think have somewhat of an objective approach, that don't just chill random altcoins, that don't just hype the market, but that actually have some kind of quantifiable approach to things. Maybe try to find another approach how to beat the market, right? So that's my personal approach. My approach is to use data, but many people outperform the market with very different approaches. They are the networkers, right? So if you were to say network with a lot of people in the space, you talk to many people that launch crypto projects, you have a direct connection with them, they become your friends, you meet them face to face, you have dinner with them, etc. You will get information that the vast majority of the market will not have. And while insider trading is a problem in traditional finance, the boundaries are not as clear in crypto. And the enforcement in crypto is also very different. And so there's many people that simply made money without any analytical knowledge. They are people persons, right? They like to talk with people. I like to just look at numbers. Many people like to talk with people. And if you are that kind of person, just go to different crypto events. Just go to, say, Token 2049 in Dubai or in Singapore. Next one will be in Dubai. I might be there as well, by the way. And just talk to people and learn about things, make friends, and get knowledge and information that others don't have, and make money that way, right? So there's many ways to beat the market. There's many paths to Rome, or all roads lead to Rome. I don't know what the exact saying is, but there's many ways to generate some alpha. Just don't make the mistake of thinking that without the work you will beat the market. Just a minority beats the market. The vast majority underperforms when they try to actively trade, and you need to have some kind of an edge, right? You need to put in the time, and how you put in the time is then up to you. Of course, you can also just join the copy trading vaults, and I hope to beat the market. I have beaten the market in the past, but if I will in the future, of course, nobody knows as well, right? There's no guarantee. Here, this is the fundamental issue with the altcoins, right? There's so much token dilution. Every week, we have roughly 1 additional billion of selling pressure, and there's not that much demand. There's no stable coins getting into the space, and that's simply just depressing the prices.
With potential crash with all these elevated prices across assets, are you holding cash at all to benefit from this event? Yes, I do. I have a lot of cash right now. My cash allocation is very high. And with cash, I of course mean fixed deposits or something that still returns percentages, right? I still want to get some return. I don't want to get diluted from the monetary base entirely. When you look at the very long term of USM2, right, this is a logarithmic chart. It tends to go up almost like a straight line. In other words, the monetary base tends to expand pretty consistently. On a linear scale, this looks like a very quickly accelerating rising line. And this is appreciating by 6.8% per annum, right? So this is how quickly the monetary base is devaluing. And that's always the argument why we should buy assets. And it's a very valid argument, right? We have to buy something in order to not get diluted by 6.8% per annum. But what this also means is it gives us a good measuring stick. So if we have a fixed deposit and that returns 4% or even 5%, then yes, we do lose money. We do get diluted year over year. But if you have 5% versus, say, 6.8%, you're really, quote unquote, only using 1.8% per annum. And then the question is the volatility high enough that you can justify a loss of 1.8%? Do you think there will be potentially an entry opportunity where prices drop by more than that? If you think that valuations are currently high and that we might drop below current price levels, then having a high cash allocation, I think, does make sense. And it doesn't even have to be a particular asset. So that's actually what many people, I think, get wrong. Many people just look, say, at the stock market and they say time in the market beats timing the market. And many studies have been made around this, right? So many people really say actually that you simply just dollar cost average into the market. You should invest into your 401k. You should just forget about the price movements and allocate towards that. And it does make sense if you just look at one asset class. So if you just decide, should I be in cash or should I be in stocks? Then you try to time the market because you think stocks are currently super expensive. Thus, I have a lot of cash. That's probably the wrong way to go about things. But if you've got a diversified portfolio, I think a cash allocation should be part of that portfolio if valuations of all other asset classes are currently high. So we're actually not waiting for the crash of, say, the S&P 500. We are just waiting for a crash or for a reduction in valuations for any of the asset classes that we are holding. So if any asset class becomes cheap, so let's say that's Bitcoin or that's stocks or that's property or that's precious metals, if anything that we currently hold suddenly goes down in price, then we can buy that bottom. Then we can buy that bottom with either something that had appreciated a lot that we don't want to have that much exposure to, or we can buy the bottom with our cash allocation. But cash is a good addition to a diversified portfolio to take advantage of bottoms, especially if your net worth is high. If you've got several years of net worth, you want to have somewhat of a diversified portfolio and you want to allocate the weighting of different asset classes based on what's currently very cheap versus very expensive. And if currently you see most things being expensive, then having a large cash allocation, I think does make sense. And we're not waiting for the stock market crash. That's what most of those studies get wrong. We are just waiting for something to crash, and something can very easily crash at some point, right? So we don't have to wait that long. If there's 4 different asset classes that aren't that highly correlated to each other, the frequency on average of those crashes coming is 4 times higher. And so that's why it's okay to sometimes be in cash, to lose, say, 2% per annum versus monetary debasement. That's fine, because something in the next 3-4 years is probably going to come down. And we already see how Bitcoin has come down 50% from the all-time high. So having some cash allocation has been quite wise, because now you could potentially already start buying Bitcoin if you wanted to. Of course, I still bet on falling prices, but let's say we were to go above the best moving averages in Bitcoin and Ethereum. If suddenly the momentum turns bullish again and we stay close to the realized price, then I might also add some allocation again. But yeah, that's, I think, is the best approach now. We want to make sure that we don't panic around holding some fiat. We want to have some physical precious metals. We want to have, if we can, some property. We want to have many things, but at the same time, we want to adjust our weighting. And having some cash is also fine, because sometimes you also get a liquidity crunch across all asset classes, right? If you still remember the COVID crash, during COVID, even gold crashed quickly because everybody needed cash. And so if you've got some cash, you can buy the dip in gold when COVID crashes. Of course, when there's a crash, then you want to buy the thing that crashes the most. You don't necessarily want to buy gold. But that's why moving from, say, gold in order to buy Bitcoin can work in regular market environments, but it might not work during a flash crash, because during a flash crash, everything sells off and then cash is king. There are situations in the market where cash is indeed king. Which would be your favorite vaults for starting to dollar cost averaging now? So that's referring to the copy trading vaults for the premium membership, right? So there's the automatic copy trading, where I share how we follow the trend in Bitcoin, right? The historically best moving averages in Bitcoin. So we also follow the best moving averages in Ethereum, and where we then short the altcoins, relatively speaking. Very short term, of course, the altcoin relative valuation trades can potentially perform a bit poorly, right? We've seen the bad performance of Bitcoin, Ethereum, and Solana versus the altcoins in the last few days. So there is the potential that relative valuations will suffer for a bit longer. But we never know, right? We can also turn around. Like, I could have said the exact same thing in September of last year, and then suddenly we started rallying again. So there is some risk in relative valuation trades. That being said, the main decision point should be, what do you actually want to achieve? Do you want to have returns that are independent of the general macro? So do you want to have no exposure to Bitcoin going up or down, simply making money by the devaluation of altcoins? So if your target is just US dollar gains with hopefully not that much risk, then the relative valuation trade vault is for you, right? So that's for all the annual members of Premium. If you're long-term bullish on Ethereum and you want to take advantage of the strong trends that we see in Ethereum, and you're okay to take quite a bit of risk, then the Ethereum trend following is the best, because that's historically, through the backtest, at the highest outperformance. The target for the trend followers is not to make US dollar gains. The target for the trend followers is to make gains versus the underlying. So let's say Ethereum crashes by 50% and this vault just stays flat, then this is a gain. Then this is good for us, right? Because we have doubled our stack measured in Ethereum. So we want to just outperform the underlying with the trend followers. The outperformance for the Ethereum trend following was historically more than 200% APY. The outperformance versus Bitcoin on the Bitcoin trend following was more than 100% per annum. So we more than doubled our Bitcoin stack on average with those trend followers. So it really depends on, do you want to accumulate more Bitcoin long term? Do you want to take advantage of more trends, more levered moves through trading Ethereum? Do you potentially also want to hold Ethereum long term? Or are you not interested in any long-term crypto exposure at all? Do you think that crypto will crash over the next 5 to 10 years? Everything is over. In that case, you probably do not want to have long-term exposure to Bitcoin. Right? If Bitcoin was to crash by another 99% and we just keep our capital, would be great for this vault, but it would not be great for your investment thesis. So in that case, if you just want to have US dollar gains that are in percent terms lower historically, but that aren't dependent on the general macro, then it's the relative valuation trade vault. Hope that explains a few things. So The monthly membership gives access to the Bitcoin and Ethereum trend following. The annual membership also gives access to the relative valuation vault. And the platforms, I sometimes get asked this as well. This is not necessarily answered in many of the videos that are published. The vaults are on Hyperliquid, so that's for Bitcoin and it's for relative valuation trades. They're on Hyperliquid, the largest of the perpetual futures decentralized finance platforms, and the Ethereum trade vault is on Gravity. And here's also the cost associated with this. You have a deposit tax for the Hyperliquid related vaults. That's a 5%. And you've got a profit share of 10% for all of those vaults. So if you're doubling, measured in US dollars, your capital, then 10% of this 100% that you made will be taken as a profit share.
There's so much more value to come. You've only watched a small, tiny clip video. The entire episode is available over here. Just press here to watch the video.